Hello, good evening.
Good evening, sir.
Trust we have a lovely day. All right, please let us check our speaker. Let's ensure the speaker is put in mute, is muted. We move straight to the business of tonight. We are looking at finance success. What are the sources of finance? We started this topic last week. We tried to underscore, excuse me, the importance of this topic, finance success. How can companies source finance? What are the different methods that is available to businesses in order to raise finance? We looked at the definition of financial management so as to underscore the importance of this topic. If you look at the definition of financial management is defined as an integral part of management that is concerned with how companies source finance. Somebody is asking when will the class commence? When the class has started. We define financial management as an integral part of management that is concerned with how companies source finance, how companies utilize finance so as to meet the objective of a business entity. If you look at that definition, source of finance or finance success is an integral part of financial management. Last week, we focused on equity financing. If you recall, we said finance sources can be categorized into two: equity finance success and debt finance success. Last week, we focused on equity financing. Tonight, we shall explain debt financing. What are the sources of debt finance? What is debt finance? Debt finance collectively refers to other people's money used in financing business activities. Remember, equity finance, money that belongs to the owner of the business. This money is used to finance the business. Debt finance collectively refers to other people's money used in financing business activities. Any money used in the business that is not coming from the shareholders will be regarded as debt finance. Let me repeat that point. Any money used in the business that is not coming from the shareholders. Remember, shareholders are the owners of the business. Any money that is coming to the business but is not coming from the owners of the business will be categorized as debt finance. In other words, debt finance refers to all forms of borrowing. Our debt finance can be classified, debt finance sources can be subdivided into 2 or 3. We have long-term debt finance, medium-term debt finance, and short-term debt finance. In other words, company can borrow money for long term. Company can use debt finance for medium term. And company can use short-term debt finance. We shall come to them individually. Let us start with long-term debt finance as well as medium-term debt finance. When we say long-term debt finance, these are finance for a longer period of time of maturity, usually above 7 years. If you are talking of medium-term debt finance, these are finance with a maturity of up to 5 to 7 years. Now, what are the examples of long-term debt finance? Please listen very well to this. We are going to classify it again. Our debt finance can also be classified into marketable debt security and non-marketable debt security. Our debt finance, we can classify it into marketable debt and non-marketable debt. What is marketable debt security? These are debt instruments that are tradable at the capital markets. Marketable debt securities. These are debt instruments that can be traded at the capital market. When we say traded, you can buy or sell. Marketable debt security. These are debt securities that can be traded at the debt market. The debt market is the bond market. Companies can go to this market to sell debt. You can issue bond. You can issue debentures. When you are issuing, you want to sell bond. Investors can go to this market and buy. Hence, we call them marketable debt securities. Examples are bond. A bond is a debt instrument that can be used by a company to borrow money. You also have loan stock. A loan stock is a debt security that can be used to borrow money. We have debentures. Debentures can be used to borrow money. If a company is planning to borrow money, a company can issue debentures with an intent to raise finance. All right? Now, you can have redeemable debt. Redeemable debt security. You can have what we call redeemable debt security. These are debt security with a specific repayment date. Redeemable debt. Debt that has a specific maturity date. A company can issue bond for 5 years, 10 years. Once there's a specific maturity date, then you are going to refer to it as redeemable debt security. You can also have a debt that is irredeemable debt. Irredeemable debt security or permanent debt. These are debts without a specific repayment date. The borrower will not repay the loan. We call it irredeemable debt. Please, just 1 minute. All right. Just to take water. Irredeemable debt. You can have irredeemable bond or irredeemable loan stock or irredeemable debentures. They refer to the same thing. A debt instrument without a specific maturity date. The borrower will continue to pay the interest on the debt, but the principal amount will not be repaid. The borrower continues to pay us interest annually, inasmuch as the company is in existence. The company will continue to pay the interest on the loan, but the principal amount will not be repaid. That is irredeemable debt security. We have explained redeemable debt. That could be, a debt could be bond or debentures or loan stock or loan notes. So if the examiner says redeemable debt, a debt with a specific maturity date. Number two, irredeemable debt. A debt without a specific maturity date. Number 3, you have convertible debt, convertible loan stock, convertible bond, convertible debentures. They refer to the same thing. What is convertible bond or convertible debt? As the name implies, convertible debt are debt securities that can be converted to equity shares. Convertible debt. These are debt instruments that give the debt holder the rights but not the obligation to convert the debt to equity shares. I will explain that further. Convertible debt. These are debt instruments that gives the debt holder, that is the bond holder, the rights, but not the obligation to convert the debt instruments into equity shares. Let us illustrate this. Assuming Dangote PSC. Dangote PSC is planning to raise finance. And Dangote want to use convertible debt. Dangote will issue the convertible debt. We can invest in this convertible debt. Any of us can invest. Whoever invests in this convertible debt instrument will be referred to as the debt holder. The investor is the debt holder. Technically, the investors are the lender. You are providing money to support Dangote business. In return, Dangote will pay you interest. Now, under convertible debt, you have a right to convert that debt to equity shares. The investor, the debt holder, the bond holder, they refer to the same thing. The debt holder has a right to convert the debt to equity shares within a specified period. Once you exercise your right of conversion, the debt will be converted to equity shares. That means you are going to move from debt holder. You now become part of the shareholders in Dangote. Once you exercise your right of conversion, the debt, the loan you are giving to Dangote will be converted to equity shares. That means your loan will not be repaid, because you are now part of the shareholders in Dangote. Now, the question you are going to try to ask yourself is, why would company prefer to issue convertible bond? What are the benefits of convertible bond, convertible debt to the company and to the investor? You know, if you are reading, you are also going to try to query what you are reading. Companies have different means of financing. I can issue redeemable debt. I can issue irredeemable debt. I can also issue convertible debt. Why would company prefer to issue convertible bond? You borrow money under convertible bond. That loan you are taking, you are giving the investor the right to take advantage of your equity shares. Look at it. Dangote issued convertible bond. Investor will subscribe. Technically, Dangote is borrowing money. At the same time, is giving opportunity to investors to buy Dangote, to take advantage of Dangote shares. The question will be, why? What are the benefits of issuing convertible bond? One is a cheaper means of financing. The interest rates, the interest payable on convertible bond or convertible debt is relatively cheap compared to other forms of debt finance. The interest payable on convertible bond is relatively cheaper compared to other forms of debt finance. Number two is that interest payable, we also enjoy tax relief. Then number 3 point is that company issues convertible bond or debt so as to preserve this company share price. You issue convertible debt so as to protect your share value. What does that mean? You know that if you issue more shares, if you issue equity shares, the more shares you are issuing, the more your shares at the stock market, the price of your share will fall. If the volume of your shares should increase at the market, the price of your share will likely fall. Instead of issuing equity shares directly, company can issue convertible bond as a means of protecting the equity value or the value of the company's equity shares. Because if you issue too much equity shares, the value of the price of your shares at the stock market is likely to fall. Please note this explanation. Then the last one I will mention is a bond, a debt, we call it a bond with share warrants. Please take note of my explanation. I have explained 3 things now. Redeemable debt security, irredeemable debt security, convertible debt security. The fourth one is I'll come back to the fourth one. Let me go to it. Yeah, a bond with warrants attached. It's called bond with share warrants. Yes, Mr. Joseph.
Good evening.
Please go ahead, Mr. Joseph.
So please, I want you to assist me. What page can I find this topic?
Which of the page are you looking for, please?
Hello, sir.
Which of the page are you looking for, please?
No, I mean this topic in question we are treating, sir.
Oh.
Sorry about
Please, before you get onto the class, you can go to that place, open it on your study pack.
That is this topic we are treating now, sir.
Source of finance. I don't know the page on your study pack because I don't even have that in my head.
Please open to 134.
Source of finance is what we are treating.
134.
And please, before you get to it,
sir.
I always try to introduce the topic. At the start of this class, I said we are doing finance subjects. It will be wrong for me to be reading what you have already. You know, you have the soft copy already. If I come to class and be reading it, it makes no meaning. You can as well read it yourself now. Do you understand this? What I need to do is to try to explain it. So what page, please? Somebody mentioned the page just now.
Yes, sir. 134.
Okay, page 134.
Yes, sir.
You can refer to it. All right, I want to explain bond with share warrants. A bond with share warrants is a debt instrument that comes with share warrants attachments. A bond with share warrants is a debt instrument that comes with share warrants attachments. The share warrants are a form of option. The share warrants gives the holder the rights, but not the obligation. The warrants give the holder the right, but not the obligation to subscribe for a specified quantity of new shares in the company at a future date, at a fixed purchase price. The share warrants gives the holder the rights, but not the obligation to subscribe for a specified quantity of new shares in the company at a future specified date, at a fixed purchase price. The warrants can be detached from the bond. A bond with share warrants. The share warrants can be detached from the bond and traded independent of the bond. The share warrants can be detached from the bond and traded independently. Whether the bond holder exercises the warrants or not, whether the bond holder exercises the warrants or not, the debt will be redeemed at maturity. Let me try to bring this out closer to you. Recall we explained convertible bond, convertible debt. Now look at it here. Convertible debt, we said these are debt instruments that gives the debt holder the right, but not the obligation to convert the debt to equity shares. To convert the debt to equity shares. Once the debt holder exercises his rights, the debt will be converted to equity shares. That means the debt holder has become shareholder. That is convertible debt. Now look at a debt with share warrants. A bond is a debt, please. When I say bond, it's also debt. A debt with share warrants attachment. You have two instruments combined as one. You know, for convertible debt, you only have one instrument. That instrument is a convertible debt. Once you exercise your rights, the instrument will be converted to equity shares. But if you are talking of bond with share warrants, you have two instruments combined as one. One is the bond instrument, second is the share warrant instrument. That share warrant give you the right to subscribe for shares in the company. And you are going to pay for the shares. Now, whether you subscribe for the shares or not, the bond will still be redeemed at maturity. Company can decide to use bond with share warrants to source finance. You can issue debt. You want to borrow money. Oh. Madam, please, can you mute? You can issue debt with an intent to borrow money. You now attach share warrant to it. That share warrant attached, you are giving the investor the right to subscribe for a specified number of shares in your company at a fixed purchase price. The holder can either use the warrants or not. Now the question is whether the holder uses the warrant or not, you are still going to repay the debt at maturity. So assuming you are asked, differentiate between convertible bond and a bond with share warrant attachment. 5 marks. Assuming you are asked to differentiate between convertible bond, that is convertible debt, and a debt with share warrants. Tell us the difference between these two. What will be our response? Both can be used to borrow money. Both instruments can be used to borrow money for a longer period of time. But what is the difference between these two? The difference is for convertible bond, there's just one instrument. These instruments can be converted to equity shares. Once the right is exercised, the debt will be automatically converted to equity shares. It means that the debt will not be repaid. But for a bond with share warrants, 2 instruments combined as one. The warrants are detachable from the bond. The bond are redeemed, will be redeemed at maturity. That means the bond will be repaid at maturity. The warrants give the holder the right to subscribe for shares in the company. So please note the difference between the two. What are other things that can come from debt finance? One is that let me quickly explain this. Remember, all debt finance comes with interest elements. If a company is planning to borrow money, remember that the company will pay interest cost. Point number two is that debt finance might be secured against the assets of the borrower. A debt finance might be secured against the asset of the borrower. When a debt is secured, the lender has the right to seek repayment of the outstanding debt out of the secured assets. If a company approaches a bank to borrow money, bank will ask you for collateral, a security. Provide us with assets or property that can serve as security for this loan. That means a debt may be secured on the assets of the borrower. It also means that if a company is planning to borrow money, you must ask yourself, do you have sufficient assets? At least up to that place, can you guys hear me?
No, sir.
I will
We
go
did
back
not hear
to
anything. No, we did not hear anything.
It's from that
can you imagine?
You can start from convertible.
the difference between
Convertible.
Somebody just speak. Can
debt warrant.
somebody just speak? Not chorus. That
Okay.
chorus serious. No way I will know what to do.
Okay.
Whoever is speaking, you can raise up you can signify and speak for the class. Who want to speak? Yes, Grace.
Okay, sir. So we stop hearing you from that difference between convertible debt and debt warrants.
Okay, convertible debt and debt to
Yes.
share warrants. Have you?
Yes, the differences.
Okay,
like
let's go back to it. Oh, let's go back to that's fine. Okay. I try to bring out the differences between convertible debt and a debt with share warrants. So I try to bring out the differences. That's fine. Now I said convertible debt. You have just one instrument. A debt instrument that can be converted to ordinary shares. Convertible debt. You have just one instrument. A debt instrument that can be converted to ordinary shares. Once the debt holder exercises his rights of conversion, that debt will be converted to equity shares. That means the debt instrument will automatically be converted to equity shares. If the debt instrument is converted to equity shares, that means the debt will not be repaid because it has been converted to ordinary shares. It also means interest will not be paid again on the debt because it has been converted to ordinary shares. The holder will now collect dividends. Is that clear, please? Is that clear, please?
Yes, sir.
Yes, sir.
Now, a debt with share warrants. A debt, that is, it could be a bond. A bond is a debt. A bond with share warrants. We have two instruments combined as one. We have the debt instrument and the share warrant instrument attached to the bond. These two instruments are combined as one. A bond with a share warrant. The share warrants can be detached from the bond. The share warrants can be detached from the bond. It means that those share warrants can be used to buy shares in the company. The share warrants can be used to buy shares in the company. Now, whether you subscribe for shares or not, the bond will still be redeemed at maturity. Can you see the difference? The difference is that for bond with share warrants, it's a debt that will be redeemed. Whether we use the share warrants or we don't use the share warrants. But for convertible bond, convertible debt, it's just one instrument. Once you use the instrument to buy shares, once you convert to shares, the debt will not be repaid. I hope it's clear now. I hope this is clear.
Yes, sir.
Yes, sir.
Sir.
All right. Yes, Andrew.
Hello, good evening. Good evening, sir.
Yes, please go ahead.
I would like to get clarity
Right.
on this. I'd like to get clarity on this a bond with share warrant. Does it mean that if you exercise the right by using the warrant, it means that you still need to pay back at maturity the bond, or it's just that once you exercise the warrant with on a bond with share with warrant, you can no longer pay back the bond?
All right, thank you for the question. Let me get the second question. I don't know, maybe the same question. Yes, Ogechi, your hand is up. Andrew, I will respond to you.
All right, sir.
You can mute. Ogechi, your comment, your question. Maybe she's not aware she has clicked on that. Let's go ahead. Now, I'm going to explain this with illustration. I'm going to explain this with illustration. Andrew, assuming Dangote issues bond with share warrants. Dangote is the issuer. You now invest in this bond. Dangote has issued a bond with share warrants. You now invest in this bond with share warrants. You are now the holder. You are going to part with your money. Dangote will issue to you an instrument, a bond with share warrant attachment. You are now the investor. Dangote is the borrower. You are the lender. Whoever invests in bond is the lender. The company is Dangote. Dangote is the borrower. You are the lender. That instrument share warrant give you a right to subscribe for specified number of Dangote shares. You are given a bond with share warrant. That share warrant gives the right to you to be able to subscribe for, to buy Dangote shares at a fixed price. Whether you subscribe for these shares or not, Dangote will still repay you the loan at maturity. The loan will still be repaid. If you subscribe for the shares, you are going to use the warrants. Look at it. You have a bond with share warrant, two instruments combined as one. That warrant can be detached. You are going to use the warrant to buy Dangote shares. Whether you buy Dangote shares or not, at maturity, Dangote will still redeem the bond. Redemption means Dangote will still repay the loan back to you. That is debt with share warrant. That share warrant gives you the right, but not obligation, to buy certain number of Dangote shares at a fixed price. That share warrant gives you opportunity to buy certain number of Dangote equity shares at a fixed price. Whether you buy Dangote shares or not, at maturity, the bond will be redeemed. It means that at maturity, Dangote will repay the money you have invested in the company. Is it better, please?
Yes, I well understood. Thank you.
Okay. Ogechi, I've been calling you, didn't say anything. Okay, Oluwakemi, please go ahead.
I'm sorry, let me ask my question now. This is Ogechi. Still on the bond with warrants. I totally understand the convertible and partly the bond with warrants. Let's assume you buy a bond with warrants of 50,000. You will definitely get back your capital redeemed at maybe 30 days after the
The
bond
amount
has been bought.
invested.
Yeah, the amount you invested. So is it not like inside the 50,000 you invested, you decide to maybe take 30,000 out of it to buy shares in the company, and then at redemption they will redeem 20,000 back to you? Or is it that you just carry?
No, please. It's good you even ask. Okay, but that's not it. I will explain it again. Let me get Kemi's comment so that I can take it together. Oluwakemi.
Well done, sir. For
Yes, sir.
irredeemable debt, where you see interest will be paid to perpetuity, can the ownership of that debt be transferred? That's my question number one. What if the holder passes away? Who will be collecting the interest? That has been on my mind, please.
That has been on your mind. Kemi. All right, let me start with Ogechi's comments. Her comment is she understood the fact that the bond will share warrants, the company will repay you your loan. But if you are subscribing for shares, it's not that they will take part of the money you have used. They will not, maybe you have used 50,000 to subscribe for bond with share warrant. If you now subscribe for shares, they will not take like 20,000 to buy shares. That's not the way it works. If you want to subscribe, if you want to use the share warrant to subscribe for shares, you are going to bring out another money now. Assuming you want to subscribe for shares that was 30,000 naira, you are going to produce another 30,000 naira to buy Dangote shares. But you cannot ask yourself, if you look at the way it works, because I'm explaining from the angle that these are means of financing. A bond with share warrants, company can issue bond with share warrant to raise finance. But if you go into its details, is that before you can exercise your rights, something must motivate you. Something must motivate you to exercise your rights. At the point of issuing this bond, Dangote will says, you can subscribe for 10,000 shares in our company at a price of 30 naira per share. We are giving you a share warrant to be able to subscribe for 10,000 shares in our company at a price of, at a fixed purchase price of 30 naira. You can buy 10,000 shares at 30 naira. You now wait. You know it's a right, not an obligation. You are not going to watch the stock market. Assuming at the stock market, Dangote shares is trading for, say, 50 naira per share. Assuming at the stock market now, you have invested in a bond with share warrants. 6 months later, you observe that at the stock market, Dangote shares is now trading at 50 naira per share. And you have gotten a warrant. That warrant gives you right to buy at 30 naira per share. The question is, will you exercise your rights? Will you exercise your warrant or not? Hello, class.
Yes, sir. We will.
I will exercise.
Thank you. The appropriate thing to do is, because the price at the stock market is 50 naira, and you have obtained a right to buy at 30 naira, that means it is profitable for you to exercise your warrants. You are going to buy shares that are worth 50 naira at 30 naira per share. You can easily sell and make a profit of how much? 20 naira. In that case, you are going to exercise the warrants. But if the share price happens to be 15 naira at the stock market, and the warrants say come and buy for 30 naira, will you buy? Definitely no. You are not going to use the warrants. So that has worked. So you are still going to, if you exercise the warrants, you are going to produce another money, not from the initial money you invested though. That answers Ogechi's question.
Thank you, sir.
Now to Oluwakemi's question. The first question I'll pick is, can that instrument be transferred to another person? Yes. Redeemable debt instruments is a marketable debt instrument. You can go and market it. You can sell it. Another person will take over from you. Once you are selling it, that means you are no longer the debt holder. You have transferred the instrument to another person. So you can sell. It is transferable. It is tradable. It is marketable. Now the second question is, company will pay interest forever, perpetuity. Yes. What happens if the bondholder dies? That is now left for individuals. It is your responsibility to create who is going to be alternative to your income, to your money when you are no longer, when you are not alive. In most cases, we play with it, right? If you go into investment, they will always ask you, who is the next of kin? Fill this form for us. Fill alternative account number for us. You should be aware that, yes, most of us are still very young. Some of us are actually elderly. If you are getting to a certain age in life, once you approach 60, make your son or your daughter a signatory to your account. Bank make provision for this. So who is going to continue to get the interest? It's a function of who the bondholder has supplied as the next of kin. So I can move on from here. And you can put your wife. But make sure you supply so one name. All right. I was trying to explain that when you come to debt finance, don't forget, interest payments will apply. If a company borrows money, whether short-term debt, medium-term debt, long-term debt, we have to pay interest. Also, for debt finance, I mentioned this, but due to the audio issue, I have to explain it again. Debt finance might be secured or unsecured. At times, the lender will require collateral security. You want to obtain loan, you go to a bank or you issue a bond. You want people to subscribe. Some might tell us, please, can you provide us with assets as collateral security? So a debt may be secured or unsecured. If a debt is secured, that means in case the borrower fails to pay, the lender can go to the secured asset and realize his money. If I borrow you money and you have used your car as security for the money, in case the borrower fails to pay, I can pick your car and sell so as to recover my money. That means the secured assets, the secured asset provide alternative source of repayments. To the lender, the secured asset provide alternative source of repayment. Where a debt is not secured, there is no second source of repayment. So please note, if you are thinking of debt finance, you might require collateral. That's also noted. Also, the last aspect before I go out of here. Yes, David.
Okay, good evening, sir. Sorry,
Welcome.
I want to know, is it possible to use intellectual property as collateral? Like the
Is it
borrower
possible
can
to
use
use?
intellectual property as a collateral?
That's an intangible asset. Under Islamic finance, that will be our next topic. That will be our still under source of finance. By the time we get to Islamic finance, intellectual property is also part of an asset. But under Western finance, it's the intellectual property. There's no way to owe you now. It's like saying that's your knowledge now. that you are so knowledgeable, so I should borrow you money. How do you pay back? With your knowledge? So intellectual property is an asset, but it's an intangible asset. We cannot hold on to it. So under conventional financing, intellectual property will not be able to stand as collateral. Is that clear, sir?
Yes, sir. But what if it is valued now? These properties can be valued.
We value it now. You know, you can value your worth. You can value your goodwill, have you? You now
Yes,
go
sir.
to bank and say, this is my goodwill. I'm credit worthy. I'm known in my village. So please give me a loan of 50 million. Assuming you are the bank manager, will you give that loan?
Hello, sir, but I'm just asking.
You know, there's certain things you know that I now approach a bank and I say, I'm blessed with intellectual property. I can discuss finance very well. And I can discuss business finance. So plan, come and give me loan. Won't they laugh at me? They will laugh at you now.
Yes, sir, you're funny. But you know, you have others that like your patent, your copyright, all those things that can be valued.
Like what?
Maybe like
your
patents or
patents.
copyright. Yes, sir.
Look, like your patents. Like you say, okay, I have a patent rights. I'm the sole producer of these products. That's a patent. Government has given you patent to be the sole producer. So because of that, give me loan to produce the product. Does that guarantee that the product will succeed? The question bank we ask is, if you have gotten a patent, we agree. You are the sole producer, we agree. But is this a sufficient guide that if you produce this product, people will buy it? If people don't buy the products and bank has advanced loan to you, how will you repay the bank? That is the way bank will reason it out. You can be a sole producer now, it doesn't matter now. But it doesn't mean that because you so produce, people will be forced to buy. So bank will be trying to ask themselves that ways. If this man produce, except you are saying that whatever you produce will serve as that's your output, we can hold on to it. But that's not even sufficient anyway. I know a classical case of a bank. I don't want to mention the name. After advancing loan, it's an Indian company. They came to Nigeria, they go into car production. Car production, they import all the parts, they assemble in Nigeria. Bank advance loan to this company that on the understanding that you are going to produce car and make sales. They produce car in thousands, but they couldn't make that sales. And bank has advanced loan. Bank can see the cars, but cash is not coming. Customers, people are not buying the cars. At a point, bank was forced to start taking the cars to use for their own marketing. But they realized that they cannot realize that they discovered that this customer cannot pay back. They were parking the cars and they were giving their marketing staff to go and market. That wasn't the intention of the loan. Bank didn't intend to buy the car. Bank was forced to start picking the customer's products and be using it as their own marketing car, so as to reduce their loss. The customer was like, I couldn't make sales. You can see the car in my compound. I'm not running away. Can you appreciate it now? But if the customer has produced a property as asset, bank will have seized that property. All right, so we have said a lot on that. Then the other aspect I want to mention is committed and uncommitted fund. What is committed funds? What is uncommitted fund? Committed fund. Most debt finance is committed, which means that the lender has undertaken to provide the finance to the borrower. The lender has undertaken to provide the finance to the borrower over agreed specified maturity period. And the borrower is not at any risk. The lender will demand immediate repayment before maturity. That's committed funds. Let me explain that again. Committed fund. Most debt finance is committed. This implies that the lender is committed to provide the finance to the borrower over the agreed maturity period. And the borrower does not have the risk that the lender will demand immediate repayment of the debt before the agreed maturity date. That is committed fund. For example, if you approach a bank now, your company, you approach a bank to borrow money for your business. You are the borrower. Bank is the lender. Bank will provide the finance for you. Assuming you want to borrow 50 million naira. The lender is committed to provide 50 million naira to you over the agreed maturity period. Assuming you want to borrow this money for 2 years. That means bank will give you this money for 2 years. The borrower does not expect the lender to come and demand immediate repayment until the maturity period. That means the lender must wait for 2 years before you repay. That is committed fund. We now have uncommitted fund. Some lending is uncommitted, which means that the lender is not obliged. The lender is not obligated to provide the fund, the finance for you. Uncommitted funds, the lender is not obligated to provide or to lend the money. Having provided you the money, the lender can demand immediate repayment at any time. That is uncommitted fund. Bank overdraft facility is an uncommitted lending. Bank overdraft facility is normally an uncommitted lending by bank. If bank should give you overdraft, bank is doing you a favor. Bank can tell you to repay the overdraft at any time. All right. Let's round up the explanation and try to solve at least a question. Under short-term finance, we have explained all this. Yes, let me round up. Short-term finance, short-term debt financing. You have bank overdraft. What is bank overdraft? Where bank that a company might arrange bank overdraft to finance its need for cash to meet payment obligation. Overdraft facility is negotiated with a bank, which allows you or which set a limit to the amount of overdraft that is allowed. Technically, overdraft is withdrawing an amount over your current available balance. A company may be authorized to overdraw its accounts. A company may be authorized to overdraw its accounts up to certain limits. In other words, company can adopt overdraft as a means of financing. That will fall under short-term finance. But please note, overdraft facility is for short-term operational needs. Overdraft facility is used to finance cash deficit from operational activities. Number two is your bank balance. The company bank balance should fluctuate regularly between deficit and surplus. When it comes to overdraft, you are not expected to keep your overdraft balance at a permanent point. The overdraft account should fluctuate regularly between surplus and deficit. It's an operational account. It's an account meant for operational activities. Overdraft is used to finance short-term operational needs. You cannot use overdraft to finance long-term projects. Lastly, remember, the bank normally has the right to call in an overdraft at any time. The bank normally has the right to call in an overdraft at any time and might do so if the bank believes that the company is not managing its finance very well. What can we take out for this? Overdraft as a means of finance is very risky. If you borrow money under overdraft, there is no specific repayment period. Note that. Next, short-term bank loan. Company can use short-term bank loan as a means of financing. You can borrow on short-term basis to finance your business need. Unlike overdraft facility, a bank loan is for a specific period of time. There's going to be a specific period, and there's usually a repayment schedule. So you can also recommend short-term bank loan. Number 3, we have trade credits. That is taking advantage of supplier credits. A company should try to negotiate favorable credit terms from its suppliers. You can use suppliers' credits to source finance. You can buy on credits from your supplier and pay at a later date. You can buy your raw material on credit. That is trade credit. Instead of going to bank to borrow money, you can go to your supplier, buy your raw material on credit, convert your raw material to finished product. When you make sales, pay back. Trade credit from suppliers at no cost. It's a cheaper means of financing. That will fall under short-term debt finance. Number 4, you have debt factoring. Debt factoring can also be adopted as a means of financing. How does this work? Companies that use debt factors to collect their trade receivables might obtain financing for most of their trade receivables from the factor. Companies that use debt factor to collect their trade receivables might obtain financing for most of their trade receivables from the factor. Who is a factor? A factor is an individual or a company that is authorized to collect trade receivables on behalf of the clients. A factor is an individual or a company that is authorized to collect trade receivables on behalf of its clients. One of the services rendered by factor is to provide finance upfront up to 80% of the value of the trade receivables they are undertaking to collect. So you can adopt, company can adopt debt factoring as a means of sourcing finance. Let me illustrate this more. If a company makes sales on credit, you make sales on credit. In your book, we are going to document trade receivables. You can decide to outsource collection of your trade receivables to a factor. The factor will collect the money on your behalf. Now, this factor can provide finance for you against the trade receivables he or she is meant to collect on your behalf. That is debt factoring. The last one is operating leaks. In some cases, operating leaks might be an alternative to obtaining short-term finance. Operating leaks are similar to rental agreements for the use of non-current assets. Operating leaks are similar to rental agreement for the use of non-current assets, usually for a short period of time. Companies that obtain the use of non-current assets with operating lease arrangements avoid the need to purchase the assets and to finance the purchases with capital. Companies that adopt operating leaks as a means of obtaining the use of non-current assets avoid the need to purchase the assets and to finance the purchases with capital. You can lease an asset. Leasing is a means of financing. Instead of buying the asset, we can go into lease rental. You only pay for the lease rental amount. So you can obtain an asset under leasing. Leasing is a means of financing. Operating lease will fall under short-term finance. All right. Wow. I thought I would finish by 10. We have explained the different type of debt finance. This environment is a bit technical because the examiner will not ask you what is bank overdraft. It's very unlikely to ask you what is they might ask you that what is bank overdraft. No, very unlikely. But examiner can ask you to explain. Our company want to raise 50 million naira, 100 million naira, 200 million naira. Advise us on how to finance, how to raise this money. More like applied question. We get to it. we get to the question. Let me not preempt. So you can begin to compare which finance is better. Is it equity financing or debt finance? Which one is cheaper? Which one is riskier? Which one is less risky? When we get to question, I will talk more on that. All right, any question, please? Any question, please? All right, please go to your material. Page 130, the last question there. Question number 7. Balama PSC. Between page 136 or 7. Please go and check. Or page 143. Please check. Can somebody confirm the page, please?
On page 143.
Page 143, yes. Please check page 143. The question is Balama PSC. We can wrap up this question in 30 minutes. Are we there, please? All right, I'll go ahead with the question. Balama PSC, in brackets Balama, is a listed manufacturer of dairy products. In recent years, the company has experienced only a modest level of growth. But following the recent retirement of the chief executive, his replacement is keen to expand Balama operations. The board of directors has recently agreed to support a proposal by the new chief executive that the company purchase a new manufacturing equipment to enable it to expand its range of dairy products. The new equipment will cost 50 million naira. And the company is seeking to raise a new finance to fund the expenditure in full. However, the board of directors is undecided as to how the new finance will be raised. The board is considering either a 1-for-5 rights issue at a price of 2.50 naira per share, or a convertible loan of 50 million. Look at this. Look at that paragraph. We need to buy new equipment that will cost 50 million. So as to expand our business. That means we must raise 50 million naira. The board of directors is undecided as to how the new finance will be raised. We are not sure how we are going to get the 50 million naira. The board is now looking at 145 rights issue. At a price of 2.50 naira per share, or a convertible loan of 50 million. Look at it. Should we do rights issue to generate the 50 million, or should we issue convertible loan of 50 million? The loan will be secured against the company's freehold land and assets and building. That loan will be secured on our building. The company's share is currently quoted at a price of 3 naira per share. Look at it now. Our company needs to source 50 million naira. We are looking at two options: rights issue or convertible loan. Requirements A says, explain the terms rights issue and convertible loan. Please, who is explaining? Please, who is starting the class with explanation? You can raise up your hand and tell us. Yes, Andrew. I can see your speaker is up. What is rights issue? What is convertible loan? Oh yeah.
Right issue is a way for a company to raise additional capital by giving its existing shareholder the right to purchase more shares at a discounted price.
Oh, brilliant.
Okay.
Is a way of raising more capital by giving the existing shareholder to subscribe for more shares at a discounted price. Brilliant. Witness, what is convertible loan? Yes. Who is speaking, please? Oh yeah, somebody should answer so that we can move out of this. Yeah, Grace. Look at.
Yes, sir. Okay, so convertible debt or convertible bond or loan is also a means of raising funds, but which can be converted to equity shares in a future date or later in the future.
Okay. She said, convertible loan is also a means of raising funds, but can be converted to equity shares at future dates. But that won't give you the complete mark. I agree that it's a means of raising funds. Yes, Ogechi.
So I just want to make an attempt. Convertible bonds, just like real estate, is a means of raising funds, and then you have just one. It's just one instrument that can be converted to equity shares, and when that is done, the lender will no longer benefit interest. You only be getting dividends.
I agree, but you need to explain it as a convertible loan is a debt instrument. You know, a debt instrument is different from equity instruments. Rights issue is an equity instrument. You need to say a convertible loan is a debt instrument that can be converted to ordinary shares at the options of the debt holder. You need to tell us that it's a debt. Right issue is an equity instrument. Please, let's try to explain it very well. Look at the response. A right issue is an issue of new shares for cash to existing shareholders in proportion to their existing holding at a reduced price, at a discounted price. Issuing of new shares, equity shares. Convertible loan is a loan stock that can be converted at the options, not obligation, of the holder into ordinary shares. Or not before the maturity of the debt. Debt instrument that can be converted to equity shares. Please, let's be mindful of this. If you go to the final stage, most of these questions are coming from there. Now look at the B part of the question. Explain how the theoretical ex-strike price of 2.92 naira is calculated, and why the actual share price might be different from the Examiner says we should explain that. In just 1 minute. Yes. Requirement B says explain how the theoretical ex-strike price of 2.92 naira is calculated. Now the question is, what is theoretical ex-strike price? For those that were in class last week, we said, first, what is right issue? The issuing of new shares to existing shareholders, usually at a discounted price. That means if you are talking of right issue, you are issuing more shares to shareholders. It also means for you to talk of right issue, the company must have shares in existence. The existing shares must have a price. We now said theoretical ex-right price. What the share price ought to be after the completion of the right issue. The expected share price following the completion of a right issue. We are not saying the actual share price. At the stock market, there's a share price. After the completion of the right issue, the theoretical right price is the expected share price at the stock market. Now, how do we calculate this? We explained last week. Of course, we have to also explain today again. If you are to calculate theoretical right price, you require 4 variables. If you are required to calculate theoretical right price, you are going to require 4 variables. Please, you are going to master this computation. I will still try to solve more questions on this. Calculation of theoretical X rights price. What are the variables? 1, current price of existing shares. Let's go to the question. The company share is currently quoted at a price of 3 naira per share. We are going to pick that. The company's shares are currently quoted at 3 naira. Number 2, issue price of new shares. Recall, right issue. The issuing of new shares to existing shareholder usually at a discounted price. Let's go to the question. Look at it. The board is considering either A1 for 5 rights issue at a price of how much? 2 naira 50 kobo per share. That is the issue price of the new shares in the right issue. 2 naira 50 kobo. Number 3, number of existing shares. And number 4, number of new shares. Let's go to this question. Look at the right issue arrangements. 2 naira 50 kobo. 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 2 naira 50 the board is considering a 1-for-5. If you have to interpret this, I'll take the reading again because the line is fluctuating. The board is considering either a 1-for-5 rights issue, 1-for-5. If you have to interpret this, it means for every 5 existing shares, 1 new share will be issued as rights. If you have to interpret this out, it means that new share will be 1, existing share will be 5. For every 5 existing shares, we are going to issue 1 new shares as rights. That is 1-for-5. That means existing share we have 5, new share we have 1. 1-for-5. You have gotten the 4 variables. In this question, we don't have total number of shares. We only have units. For every 5 existing shares, issue 1 new shares as rights. You can now come here. Existing share 5. The price of existing share 3 naira. New share 1. Price of new share 2 naira 50 kobo. Get the value. Quantity multiplied by price. This will give you 15. 1 multiplied by 2 naira 50 kobo. That will give you 2.50. Sum together. Add the quantity 6. Add the total value 17.5. Therefore, your theoretical X right price is equal to total value 17.5 divided by total quantity. Check that out. 2 naira 92 kobo. That is how the examiner got 2.92. You have explained by a calculation how to calculate theoretical express price. You have explained by a calculation how to calculate, how to derive the theoretical express price. The other part of question B says, why would the actual price at the stock market value of the shares be different from the theoretical express price? You expect the share price after the completion of the right issue, right issue to be 2 naira 92 kobo in theory. Now the question is, why would the actual share price be different? The reasons are: 1, the existence of specific information, positive or negative, regarding the company or its market sector that could affect actual share price. If, for example, if you look at this company now, Balama PSC, assuming we have the information that a person like not anybody, but I want to explain this for knowledge purposes. Balama PSC, assuming there's an information that says Balama has been given the rights to host Nation Cup. Balama has gotten the rights to host, to be the sole producer of the milk or the water for Nation Cup. That information is a positive one. The company has won the rights to distribute water at the Nation Cup events. That information will boost the company's share price. In that case, the actual share price will be higher than the theoretical price calculated. That is positive information. Alternatively, if there's information that says this company will be, the new chairman of Balama PSC will be, what name will I use now? That won't offend anybody. Imagine making Asari Dokubo the chairman of a company. Imagine that a corporate company will now say, oh, Zenith Bank, that the chairman of Zenith Bank is now Asari Dokubo. What will happen to the price of Zenith Bank shares? Yes. Or imagine that we got information that in 2 months' time, MC Oluomo will be the chairman of Zenith Bank. What do you think will happen to the share price of Zenith Bank? The share price will crash automatically. Investors, that information, investor will start dropping the shares. It's how will somebody of this character be the chairman of a bank? So information about a company will have impact on your share price. Number 2 reason is information regarding the use to which the proceeds will be used. That is, this right issue, the money generated, what are we going to use the money for? And market reaction to this information. The investor will ask you, you want to raise 50 million. What are you doing with this money? And you are doing right issue. What are you doing with this money? The market reaction to this information, that will affect actual share price. Number 3 is the expectation of the investor or the stock market regarding the company's future. Investors' expectation regarding the company's future will have impacts on the actual share price. If you observe stock market, share price is not static. If you look at China's news, they will not tell us stock market reports. The share price is always fluctuating. That share price is not static. It's a function of many variables. The expectations of the investors or the stock market regarding your company's future will have impact on your share price, on the actual share price. If investors perceive your company positively, if the investors perceive this company in positive light, then your share price is likely to rise. But if the investor perceives the company in negative light, the stock market is not seeing your company in positive light, the share price will drop. And that will make actual share price not to equal to theoretical expired price. Please, you are going to try to understand this reason. It is always examiner favorite. The last aspect of this question. Please hold on, I'm going to ask this now. The C part says, prepare a report for the board members that fully evaluates the two potential methods of financing the company's expansion. The question says, prepare a report for the board member that fully evaluates the two potential methods of financing. What are the potential methods? Rights issue. Look at it. The board of directors is considering either a 1-for-5 rights issue or a convertible loan. That means the two potential methods we are looking at is rights issue or convertible loan. So do a report to the board. Your report will explain what is rights issue. What are the benefits of financing projects with rights issue? What are the risks involved when using rights issue as a means of finance? When you are done, you now go to convertible loan. What is convertible loan? What are the benefits of financing the business with convertible loan? What are the risks involved? You can now draw your conclusion. The report is provided here. Look at the report format. To the board of directors from Good Edge, financial consultant, your date, subject matter. You are going to talk about right issue first. Please, I can't be reading this report now, sir. I'm even tired tonight itself. But more serious, let me try. More seriously, let me just try to summarize it. Look at this. For an established listed company, right issue are much more popular for the following reasons. Right issues are relatively cheap to make compared to public offer. The issue price is relatively unimportant since all existing shareholders will benefit from the cheap price. The discounted price is for all existing shareholders in proportion to their shareholdings. Hence, there's no disproportionate gain to anybody. The company needs to make the right issue, the right price, significantly cheaper than the market price. That is, the right issue should be made at a discounted price so as to motivate the existing shareholders to take up their rights and subscribe for the new shares. For this reason, right issue tends not to fail. The company can generate the needed funds. Also, with right issue, ownership and control still remain with the existing shareholders. The ownership will still remain with the existing shareholders. Let me take it up again. The need to discount the offer price to ensure the issue is fully subscribed and to cover the possibility that the market price of shares might fall. Yeah. Between the announcement of the right issue and its conclusion, we are going to discuss benefit of right issue. When you are done, now go to the convertible bond. You are going to discuss the advantages and disadvantages. You can now do your conclusion. Please go through the reports and make sure you can reproduce these reports if required in the exam. Any question, please?